I think that there are a couple key characteristics that many entrepreneurs share that are relevant to understanding the barriers that the US tax code places for entrepreneurs. Number one, many entrepreneurs tend to take a while to turn a profit. Number two, entrepreneurs tend to be quite risky ventures. And number three, entrepreneurs tend to be growth-oriented. The US tax code does penalize businesses that run large losses in their early years. It does discourage risky investment and encourage safe investments. And it does present obstacles for businesses that are expanding their operations and growing rapidly. So another area of the tax code that might be worthwhile to look at is how the tax code is treating losses by investors who are pursuing the type of risky opportunities that entrepreneurial ventures often present. Counterintuitively, the tax code provides worse treatment for capital investments, for the type of investments that lead to business growth, than it does for other sorts of business expenses.
The first thing I should say is that entrepreneurs really don't give two hoots about tax policy. They really have one major consideration: the cash coming in to be greater than the cash going out. The entrepreneur, especially the startup entrepreneur, lives out of his or her checkbook. At the end of the day, what you do to their cash position is absolutely critical. If we're going to focus on tax policy, especially for new entrepreneurs, it's when they actually are making a profit, that's when they can afford to pay tax.
The way to get a better tax code, the way to grow the economy is to tax consumption, not income, right? When you try to tax income, you start to play this big game of, well, what is income? And I'll tell you what bothers entrepreneurs is they don't have all the fringe benefits that big companies do. And big companies get away with having those as untaxed benefits. Healthcare is a big one. Fringe benefits don't count as income. That makes it a very unlevel playing field between entrepreneurs and existing larger companies. With gold-plated healthcare, with gyms, with company cars, and the government says, no, fringe benefits don't count as, fringe benefits have to count as income. And I think having an income tax code instead of a consumption-based tax code makes it extremely harder by definition.
It's important to emphasize that the tax code as it exists today does include some incentives for small business and for entrepreneurial efforts. The existence of these previous incentives complicates life if you're trying to design a new tax system. There's this asymmetry where if you're in loss-making mode, the government isn't writing you checks back. In a perfect world, you want a neutral playing field, symmetry, all of those good things. Kind of the new startup businesses are disadvantaged rather relative to the established players. And that thinking about reform that can move in the direction of leveling that playing field would remove one of the tax sort of penalties on entrepreneurial effort.